Welcome to this tutorial on financial modeling using Kaluta projection methodology. Last time we completed our business valuation basing on unlevered free cash flow. That is free cash flow attributable to both injectors of capital within the business, that is equity holders and debt holders. In this case, of course, there are other holders, maybe preference shares, bonds, and other forms of financing. But in this case, we have equity and debt holders. So now we proceed to do valuation basing on levered free cash flow. But before we do that, let us first compute unlevered free cash flow using other methods that are normally used to do that. There is a point I want to share with you relating to that. So in our business valuation here, we had our unlevered free cash flow computed by taking cash flow from operations. We added back interest. We then added back accounting tax, because these accounting tax were computed after deducting interest payment, which in this case we added interest back, so we assumed that there's no interest payment made, because we want to arrive at the free cash flow that is attributable to both debt and equity holders. And then after adding back accounting tax, we deducted theoretical tax, and that is the tax that is computed after taking back interest payment. So it's basically the tax rate that is computed on earning before interest and tax. Okay, and this is cash flow from investing activities. They have been deducted to arrive at our figure for unlevered free cash flow, which we have used for valuation purpose. Now let me create some rows here to introduce other methods of coming up with unlevered free cash flow. So I insert rows here. Insert rows. So the first one is from the cash flow itself. So we start with cash flow from operations, CFO. Okay, and we pick the figure from here. We have it here already, cash flow from operations. This one, total cash flow from operations. This one, press enter, and then from this one we added back interest. Okay, but the interest need to be after tax. Okay, interest component that we are adding back. Okay, because the interest payment has a tax shield. Okay, and that tax shield provides additional cash flow to the business. Okay, so while we are doing this valuation of unlevered free cash flow, we need to deduct the interest component that is after tax adjustment. Okay, so I put here type interest, and then in the bracket put 1 minus tax rate. Okay, so the interest component, because it is negative, I started with negative and then come to pick it here. Interest, load interest, this one, and then multiply by, open the bracket, 1 minus tax rate. Our tax rate is 30% in this case. Press enter. So we have added back interest, and then we remove cash flow from investing activities, CFIA, which is put equal sign and pick the figure here, total cash flow from investing activities, this one. So after that, then we need to get our unlevered free cash flow, UFCF. Okay, so it's just a matter of summing. Press enter, and then I can select these and fill them to the rest of our projection horizon for 3 years. Okay, so we have our unlevered free cash flow computed using the cash flow from operation as a base, and then we adjusted for the interest component. We added it back with using after tax figure, and then we remove cash flow from investing activities to arrive at this. Now you can see there is a difference between this approach and my approach. So let's see how much is the difference by starting with equal sign, taking this figure. This is my approach minus the formula approach figure, that one. Press enter, and then let us tap to fill this throughout the projection period. So you can see the difference of 150 originated in year 0, and then it reversed in year 1, but from year 2 onwards there is no difference. Both methods, my approach and this approach used universally, they are all providing the same metric of unlevered free cash flow. Okay, now let us use another one that is used, and this one is, you start with net operating profit after tax, NOPAT, which is basically earning before interest and tax, and then in the bracket 1 minus tax rate, Okay, so this is this approach is now uses the income statement, while this one we use cash flow statement. This one now we are using income statement. So this figure for EBIT comes from income statement, and in our case, so I start with equal sign and then go to annual P&L sheet here. So our EBIT in our case is this profit before tax. We added back interest component here, we get this figure adjusted. This is EBIT. Okay, it is the figure that is established by taking profit before tax and then we added back interest. So that is our EBIT, and then we said EBIT multiply by, so put multiplication, open the bracket, 1 minus tax rate, and our tax rate is 30%, close the bracket, press enter. So that is our formula for net operating profit after tax. And then because the income from income statement is established using accrual basis, that means there are non-cash items that are captured within income statement, profit and loss statement. So in this case we need to add back depreciation, which is non-cash. In our case here there is depreciation. There are other factors like unrealized gain and losses, impairment, okay, and amortization, okay. All these form the non-cash item, but in our case here it's depreciation. So I click here, start with equal sign, and then go to our, because we are dealing with annual here, so depreciation sheet for annual, and we add back depreciation figure, which is here, press enter, and then we need to changes in working capital, changes in working capital components, okay, because as I said, net income is established using accrual basis, and we want to move from cash flow from operation reported using accrual method to cash flow from operation using the actual cash. So we need to make adjustment in changes in net working capital, and we did that exercise in our annual indirect cash flow. I will take you there. So basically I'll start with equal sign here, I mean summation. No, I don't want to sum that one. So maybe, okay, let me, instead of using that, let me use this one and say start with equal sign and then sum, and then open the bracket and then click on our annual indirect cash flow sheet, this one, where we compared our direct cash flow method with this indirect cash flow method we did. So changes in working capital in this case starts from first profit before tax, then depreciation, then debtors, advance payments, closing stock, creditors, and accruals. So from debtors to accruals, all these are changes in working capital components or elements. So from our direct cash flow method. So I click on debtors here and then select up to accruals here. So that will be the net changes in working capital components. So I press enter. So we have done that, and then there is cash flow from investing activity. From investing activities, which is simply this figure we have here in our cash flow, total cash flow from investing activities, this one. Press enter. Now we have our unlevered free cash flow, unlevered free cash flow, which is just the summation of the above. And so I can select this all up to here, and then fill this to the end of our projection period, that is the 3rd year. Okay, now let us do the same again by looking at the difference between my methodology approach and this computed approach using income statement. So I start with equal sign, pick on unlevered free cash flow, original one I used from my methodology, and then minus this one from no party approach. Press enter. So let me tap to fill this throughout. So again, we have seen in this approach we have the difference. This 2.3 million originated in year 0 and then it reversed in year 1, but from year 2 onwards the approaches are the same between my methodology and theirs. Now, why do we have the same answers from year 2 to year 3 in both approaches? It is because from year 2, let us go to annual income statement here, annual profit and loss. In year 0, we had a negative profit before tax figure, okay? And from year 1, there is where we have a positive profit before tax figure. And in my assumptions, in modeling this, I said that when you have a loss, okay, that loss needs to be absorbed first by profit obtained before you can start to pay tax. This is a logical approach, okay? Because if you can't charge tax on negative figure, and as I explain this, we will see why. So this is the main difference now. So from year 1, because we have profit, then all approaches are the same when it comes to computation of unlevered free cash flow. From year 2 and year 3. But because year 0 we had loss, and this loss was first absorbed in year 1 before we charged this theoretical tax here. For example, we took the profit for year 1, we added the previous loss to reduce, that is to absorb that loss, and the net figure now is the one that we applied tax rate, okay, after absorbing the loss, okay. So for these 2 years, that's why we have difference in computation, okay. And my case is more plausible, my methodology is more plausible, because you cannot charge tax on loss, okay, because we will see it when we look at the cash flow, okay. So let's see now how do we reconcile with their approaches. It's important because you are not going to have cases where only you have profit before tax and loss before tax in your modeling. You will have the cases where you have losses before tax, and those are universal computations will not be applicable. Okay, so let's see now. Let us start with the NOPAT here. This difference, 2.3 million, is actually, if you go to annual P&L sheet here and take this adjusted, so I take this adjusted earning before interest and tax, that is profit before tax, add back interest, you get this figure, and then this figure, when you multiply it by 30% tax rate, you get that figure, 2.3 million. Let me okay, so that is the figure that created the difference in no-party approaches. Okay, and to rectify this, you know, when we computed my approach, I said for theoretical tax, I said it's 0 because we have loss. But let's say we still have to calculate theoretical tax, and let's say here also, instead of absorbing the loss first in order to charge for tax, let us use the formula used in year 2 here, which is simply adjusted figure after taking back interest, take profit before tax, add back interest, and then the total figure is the one that you multiply by 30% to arrive at theoretical tax. So let us copy this formula to be applicable from year 0. Okay, so I copy this from here to here, and then I paste. So after doing that, which means we now have a theoretical tax figure which is negative in year 0, and this one has already been corrected, that we have charged from adjusted tax figure and not from the sum of these two figures in order to absorb this one. Okay, so after doing that, if we go to our annual cash flow sheet and look at our no-party approach, we see the difference has gone out. Okay, but we have the difference in our cash flow approach. Okay, so the difference is cleared in NOPAT. Why? Because we have adjusted for the loss. Theoretical tax has also been computed on the loss figure. But in the cash flow, because our cash flow from operation is picked from is a summary. Our annual cash flow is the summary of our monthly cash flow. And in our monthly cash flows here, if I go to cash flow, let's start from P&L here. Here's where we will understand better. So in the P&L, we said for tax figure, we put a formula so that we only charge tax after the cumulative figure here has, for example, it's negative, so there's no tax, all this. When cumulative figure of profit after tax is negative, we don't have tax. Okay, you see, though we generate profit, but we are still absorbing the loss. until here the loss from January 23 we start with positive figure, and it is from here now we start to charge tax. Okay, so we charge tax on after absorbing all that. So this is the formula that I created to establish the tax component. Now let us assume that we should not follow that approach. Now we simply charge tax even on the negative figure. Okay, so I start with to edit this. So instead of B40, I pick this figure and then multiply by, so let me use this one, multiply by tax rate, that is 30%. Press enter. Okay, then I tap to fill this throughout our projection period. Okay, so after doing that, if we go back to our annual cash flow statement here, we see that even in the cash flow approach, that difference has disappeared. Okay, and of course the difference was 150 here. I will show it later, but the difference has disappeared. Why now? Because our cash flow from operations has also taken into consideration negative, the losses have been charged tax. So if I go to cash flow on monthly basis here, cash flow sheet, on the tax figure here, you will see here we have positive. Tax actually draws out cash from the business, so it needs to be negative, but in this case it is positive. So this is nonsense when you have a cash flow statement, because when you have a loss you simply don't pay tax, but the government will not give you the money because you've made loss. So there is no actual cash flow that you get by having loss, as is reported in this cash flow statement. So this is not a good way to it's not right way to account for tax. And that's why now, if you want to apply universal approaches to computations of unlevered free cash flow, then definitely know that the methodologies have limitations, because they assume that you only have cases where you have profit before tax and not loss before tax. Okay, so after saying that, now let us go back. Of course, let us simply be to where we were before, and we did adjustment in P&L here. Now I need to go back to our approach, which is the correct one. So for tax figure, I again pick it from, start with equal sign and then pick it from here, tax. Yeah, press enter and then tap to fill this. I'm just going to my normal, my previous approach, that is the correct one, and not this one that charge taxes on losses. Okay, so I've already rectified that, And on our annual profit and loss here, we need to delete this figure for profit here. So I clear this, I clear this figure. So no theoretical tax as we did. And here we made a formula here to sum this figure and this one to absorb the loss first, and then after absorbing the loss, then we multiplied it by the tax rate times 30%. Okay, so we are back to our approach, and this is the approach now that has resulted into these differences in the cash flow from my methodology, which is the appropriate one as you have seen, and from these universal computed approaches. And for cash flow, as you see, the difference was 150,000, and to know this difference is simply the tax component of the interest that has been added back. So if you come here in annual profit and loss, and let me put a formula here. So if you take this one, multiply by 30%, then what you get is that this figure, 150,000. Okay, that is this one multiplied by 30%, 150,000, and so this is the figure you get. So it's the tax component of that. So what I'm saying here is these approaches, universal approaches, match or they are correct if you have only a situation where you don't have to pay to charge tax on losses. Okay, that means you need to absorb the losses first before you start to pay tax. That situation will not give you the right unlevered free cash flow figure, and that's why I will proceed by using my figure. I saw there is a need to do this because I know you guys are well used to using these other universal approaches, and when you do this, you will see that there are differences, and you'll start to wonder why there is this difference. So I have explained it for you to make your life easier. So after doing that, now let us come to our valuation for using levered free cash flow now. Okay, so there are adjustments we need to do in our computation of levered free cash flow we did earlier. So we started with unlevered free cash flow. So let me, this one should be, should start with the word unlevered. So we started with unlevered free cash flow figure, which we picked from my methodology. This one, business valuation, the first one. Okay, and then we added loan interest, but these loan interest need to be after tax because we are now establishing levered free cash flow that is attributable to equity holders only, and the interest component actually provide a tax shield because interest are tax deductible. So there is this cash flow that is generated by having interest component because of the tax shield it has. So the interest component here we picked there. So the interest here, maybe I should type, put a bracket, interest, and then 1 minus tax rate. Okay, so our interest component there, and then multiply by, open the bracket, 1 minus tax rate, and our tax rate is 30%. Close the bracket, press enter. Okay, so this one is true throughout. It's up to fill this throughout our projection period up to 3 years. Okay, and then loan repayments, that's okay. But before loan repayments, we also need to take into consideration the loan paid or the loan disbursed. Okay, so I need to insert a row there, insert row, and then put the loan figure, edit, which was injected, it was injected in year 0 here. So I put the formula starting with equal sign, and then click on cash flow. Here we are in the cash flow here. There is this loan payment, loan. Okay, so press enter. So this, because this increases funds in the business, so it's positive. Let me tap this formula. Let me drag this formula throughout, so in case you add loans in future, it can simply take into account. So you see, after adding the loan repayment figure, now our levered free cash flow has changed. And why loan disbursements? Because the loan are the funds that are available to owners of the business to use them for the purpose of course, for the purpose on which they were sought for. Okay, of course you can use for other purposes, but definitely let us assume that you are using them for the purpose on which you have requested for the loan. So it's still available, that amount is still available to owners of the business to use it for as they please, or to use it for the purpose of growing the business. So that's why we also need to include not only loan repayments, but also loan disbursed, or we could say we put net debt. Okay, so net debt will be loan disbursed minus loan repayment, but we have put them all here. So this is our figure now for unlevered, levered free cash flow. That is the free cash flow attributed to owners of the business, and this is now the one that we are going to use for valuation purpose. Okay, so to do that, let me duplicate this sheet so that this sheet will remain to be for cash flow. We will have another sheet, the same sheet, for enterprise value, that uses unlevered free cash flow method, and another one for shareholders value that uses levered free cash flow. So I duplicate this one, I click on the sheet and then duplicate once, and then click again and duplicate twice. So the first one, okay, let's rename this. So this one stands for enterprise value, and the other one I will rename it to shareholders value. Okay, so for enterprise value, as I said, this is using unlevered free cash flow, and in our valuations here we have used unlevered free cash flow, so it's okay. For shareholders values, now we are going to make changes here. Instead of in our computation unlevered free cash flow, here we will change. Instead of unlevered free cash flow, we will use levered free cash flow. Okay, so let me edit this to levered free cash flow. Oh, sorry. Levered free cash flow. So that means I change now, I pick to this figure here. Press enter and then I tap to fill this to the end of the third year. After adjusting up to third year, the terminal value is automatically adjusted, because computation for terminal value it picks from the latest figure here, and this one has already been adjusted to take into consideration levered free cash flow. So there's no changes here in terminal value. That's why I dragged it to year 3. Okay, and for the cost of capital, instead of weighted average cost of capital, we are now going to use cost of equity. So again, I start with equal sign, go to our sheet for cost of funds, and instead of work, now we pick this 35%, which is required rate of return for equity holders, absolute figure, not weighted one. Okay, so press enter. So after doing those two adjustments, then all our computations now have been rectified using levered free cash flow, and this now is intrinsic value. NPV here is intrinsic value attributable to shareholders only. Okay, so if you have issued numbers of outstanding shares, if you divide this figure by number of outstanding share, you will get intrinsic value per share. So that figure could be the figure now for negotiation. If you want to sell your share, or if you want to buy shares, you will do this analysis, and that figure will be the starting point for your negotiations, compared to the market value which is listed in public. If this company was in the stock exchange, then you would see the market price for the share. And so if the intrinsic value per share is bigger than the market value, then we say the company is underrated, or the share is undervalued. Okay, so in that case, it's a big deal to buy it, and vice versa. So we now have our valuations basing on levered free cash flow. Okay, you can see these valuations now after using levered free cash flow have also turned out to be unrealistic. Okay, unrealistic in the sense that, okay, this here we had a formula for NPV using inbuilt. Is different from the manual because we need to, if I click there, we need to add the terminal value. So I drag this formula to include, oh sorry, so I need to drag this to include the terminal value also. Oh, does not agree. Sometimes using the tablets becomes a challenging stuff, because I just wanted to drag this to cover, yes, okay, so I have already covered that. So our computations of manual and using inbuilt Excel formula is the same. The same we need to do for, and so this one has already covered NPV. It has also taken the terminal value, okay, and for all these I've already taken consideration the XNPV. Yeah, it has already taken terminal value. So all these parameters have already taken into consideration terminal value, except for, okay, even the payback period also. Payback period, it has already, no, it has not taken terminal value for the formula. So I have to but it says, yeah, let make it cover the terminal value also. Okay, so you see our valuations now are not realistic. For example, out of this free cash flow in year 0, levered free cash flow of 3 million, within 3 years, I mean, of course, this is the projection throughout, including the terminal value, but you have NPV of 23 million out of 3 million. This is too big a figure. And even if you look at the IRR here, internal rate of return, is way big compared to what, I mean, in this case, not this now is not WACC, this is now is cost of equity. So I changed the name here to let's call it cost of equity, cost of equity, 35%. So still having an IRR which is 272 compared to 35 required rate of return is too huge. Okay, of course XIRR becomes even greater, and I've explained the reasons, the difference between XIRR and IRR. And profitability index also is huge, 9 times. Okay, so after this one, then we may say, oh, where is the problem now? Why do we can't have such a profitable business? Where is the problem in our cash flow? So in the area we did adjustment on, so let's go to monthly profit and loss. We did adjustment for, in the working sheet, we did adjustment for quantity. to reduce the expected quantity of smartphones to be sold. Okay, we did adjustment. In this case, let's say, okay, now we have made our analysis, and we realize that we have underrated our marketing expenses. Okay, so instead of 120 per month, we need, say, edit this figure, we need 500, sorry, we need 500,000, and sales promotion, instead of 200, we need, say, 800,000 per month. $800,000 per month. Okay, so after doing those adjustments, let us now go to look for our annual cash flow. I mean, for our we were doing shareholders value. Okay, so for shareholders value, now you see the valuation metrics become plausible. Okay, NPV, though this one is so much trimmed down, NPV is 236 only, IRR 37 out of 35. This is so much trimmed down. Even the payback period now turns out to be after 3 years. That is beyond our explicit projection period in the terminal value here. Okay, so maybe that one is too much, so let us go back again and reduce it a bit. So in our P&L, instead of 500,000, let us say 300,000, and instead of 800,000, let us say 500,000. Okay, let us now go back to our valuation using shareholders value. So at least this one is reasonable. This one is reasonable, taking into consideration of the riskiness of the business. Having an IRR 145 compared to cost of equity 35 is reasonable. Even the profitability index is 4 times now out from the 9. Payback period is after 1 year and 3 months. So this is plausible projection. And of course, these changes will now be in enterprise value. They have also been reflected in our valuation metrics here for unlevered free cash flow. So that is all I wanted to talk about this tutorial, and let us end up on this. Please subscribe to my channel if you haven't done yet, and please like and share, and if you have any comment, feel free to put your comment, or if you have any question relating to this Kaluta projection methodology, just put, or any other question relating to financial modeling, but in relation to this Kaluta projection methodology, because this is the new approach. You are not used to it. You don't find it in educational materials out there, because this one, I have personally developed this methodology in the course of provision of financial services to my client as a freelancer. Okay, so that's what I wanted to share with you today, guys. In the next presentation, we are going to look at how to do evaluation on monthly basis, because our projection have been done on monthly basis, so we need to see how can we do these free cash flows and valuations using monthly projected figures. So see you guys